Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the possible recession because blue chip tech stocks are now as volatile as Bitcoins, and PayPal was down over 20% in a single day last week, and inflation readings as high as they are. It seems like a recession is pretty much inevitable at this point, and it's backed by some really good data. Check this out. This is a really interesting observation that I saw in one of Meet Kevin's videos that I thought was really cool, but also really scary, which is that anytime we've had an inflation reading of above 5%, we have always followed that with a recession every single time in the last 70 years, other than once. And right now, our inflation is closer to 6.5%, if not 7% last year. So what is exactly a recession though? Maybe you knew this, I didn't know this, but a recession is officially defined as 2 back-to-back quarters or a 6-month period of negative growth. Now, how do we measure that growth exactly? That growth is measured by the GDP, the gross domestic product. And in the case of 2020, you can see from Fred St. Louis Fed, the chart shows Q1 as going down, that's the first quarter, and the second quarter really went down, marking it as an official recession. Now check this out. You see these little dark gray columns right here in between the white? Those are not good. Those are periods of recessions. Now check this out. Going back as far as 1948, when inflation hit 9%, we got a correction. Then in 1951, we tried to bring it down, but we got a recession. And we have a few between here that we get a few recessions that don't hit 5% inflation readings, but different reasons. And then in 1970, we got 6% inflation, followed by a recession. In 1974, we got 12% inflation, followed by a recession. 1980, a massive 14% inflation reading. We had a brief recession. We tried to bring that one down, but we got another recession. In 1980, same story. 2008, same story. Now we are at 6.74%, and it seems like the writing's on the wall because we need to bring down inflation. But based on what everything the past is showing us, it seems like another recession is coming. Now, a recession is kind of a scary word, right? Because it doesn't inspire investor confidence. Like if I told you to invest during a recession, you'd be like, no, I'm good. I'd rather sell everything and just wait. The question I have is, how well do stocks do in a recession? Because the answer surprised me, and I know it's gonna surprise you too. Because even if you knew that a recession was coming, selling everything and waiting might not have been the best thing to do. To quote Russell Investment Research, in order to beat a buy and hold return of 9% over the last 150 years, you would have to correctly predict the markets 77% of the time and move in and out of cash and stocks constantly, correctly, to beat that, which is almost impossible. Let's talk about exactly how stocks do in a recession, but before we get there, I want to invite my friend Jeremy from Financial Education because as much as we like to talk about numbers and complicated words about the economy, I think it's cool to have a human element in seeing a real investor invest millions of dollars and get his perspective on this, because I have some money invested. I have a couple $100,000, which is not a little, but it's not millions of dollars. And I think you're gonna learn a lot throughout this video. So let's talk to him right now. But first, a quick word from today's sponsor, Moomoo. So this is a really interesting app. Moomoo is a free stock trading app, and once you make a brokerage account, you'll be able to trade without paying any commission fees, and they don't accept payment for order flow. But get this, you'll get access to free trading view data. There's a social component to the app where you can leave comments and interact. You'll be able to compare stocks together, and you can even look at the short interest of a stock. And if all of this looks insanely complicated, the app will even interpret a lot of the data for you. But that's not even the best part. The best part is that they're giving away 5 free stocks, each worth up to $3,500. So if you sign up using my link down below, you'll get 1 free stock. If you fund your account any dollar amount, you'll get another free stock. And if you fund your account $2,000, you'll get an additional 3 free stocks. Now, I did some digging around, and they are new to the US. Their parent company, Futu Holdings Limited, has been around for over 9 years now, and Moomoo since 2018. So go try the app, get those free stocks while the offer lasts. Let me know how you like it. Thank you, Moomoo, for sponsoring this portion of the video. Now let's get back to it. The man, the legend, Jeremy, What's up, man?
Hey, I'm happy to be here.
Yeah, thank you for coming. We have a lot of questions for you, and by we, I mean just me. So why are stocks falling, man? Like, this is crazy.
Yeah, there's a lot of volatility in the market right now. We've been through quite a cycle over the past year. So if we go back a year ago, essentially, we were in a FOMO market, the peak retail trader market, which peaked out in January of 2021. And ever since then, we've had small cap stocks starting to fall first, the riskier stocks, then it was mid caps, then recently even mega caps and large caps are falling. And some of these mega caps, it's incredible. Some of them are trading like they're penny stocks now.
This is nuts. Okay, so I saw Facebook fall over 26% in a day. So I think it was like $237 billion, which is the equivalent of like the entire market cap of McDonald's and Netflix. How does that happen? Because these things are trading like crypto to me. This reminds me of the crypto markets.
I know, and you know, Facebook as of yesterday was a $900 billion market cap, which is right around the same as Bitcoin right now, roughly. And so think about it in the context of, imagine if Bitcoin fell 26% tomorrow.
People would be freaking out. For Bitcoin, people would be.
Yes, and Facebook is seen as a safe stock. That's one of the few stocks in the stock market that, you know, it's like, oh, if I put money in that, it's safe. So essentially, their guidance was very weak, meaning their upcoming quarter that they're guiding out for, much under what analysts expected. It really caught a lot of people off guard with how low the numbers were. And also, they are specifically facing a lot of competition from TikTok, which is much more than what I think Wall Street was really expecting. TikTok's actually a serious competitive threat to Facebook.
But you own Facebook stock.
I do, yes.
If it's down 26%, you must be loading the boat.
Well, I would be if it wasn't for so many other stocks being down. And so that was when I looked at today and I said, you know what, I don't actually have to buy it. And the reason being is their earnings were so bad and there was so much bad news in there and there's so many stocks down right now. And plus, a lot of my stocks still have to report, so I need to keep some capital around just in case those ones crash 26%.
Right. So you just showed me a really interesting picture from Goldman Sachs.
Yep. So many people had been playing put options, and I think that's part of what fueled us on the upside. And right now, Goldman Sachs put out, you know, they're basically doing, you know, there's about $1 trillion worth of puts a day going through right now.
So is this more of a sign that perhaps smart money knows that there's a recession coming, or is that more of a sign that we're about to bottom soon?
I think it's, if we look at 2020, it could be a sign we're about to bottom soon, which is quite crazy to think about. Like, usually what we find is everybody piles into the wrong thing at the wrong time. And if we go back to last year, everybody was piling into the meme stocks, as we know about, and anything that was seen as a riskier play, as a Cathie Wood stocks, that was the worst decision you could make, right? Right now, everybody's piling into short positions, and now everybody's betting on put options. You know, I think unless you're in, if we go into a major recession, outside of that scenario, everybody's probably piling in at the wrong time, as it always happens.
So now let's talk about the thing that matters most, which is how well do stocks perform during a recession? Let me ask you this. If you knew that a recession was coming, 100% for sure, would you leave your stocks as they are, or would you sell everything and wait to buy the dip later? Most people would sell everything and they would like to buy back later at lower prices. And this makes perfect sense. This is 100% logical. You think recession, you think things are gonna go down, I'm just gonna sell everything and wait it out. Now, check this out. This is gonna blow your mind. This is directly from Russell Investments research, and I will leave a link for that in the description below the video if you wanna check out that research. But between 1869 and 2018, we have had a grand total of 30 recessions. Now, of those 30 recessions, 16 of them had a positive stock market return from when they started to when they finished. The positive stock market recessions lasted on average 16 months, and they returned anywhere between 0.7% to as high as 38.1%. That's the spectrum, with an average return of 9.8%, despite the fact that the GDP growth was down 3% on average. How? This doesn't make any sense. This is crazy. In fact, they measured the correlation between the GDP and the stock market to be at negative 0.05, which is basically zero. There's no correlation between GDP growth and the stock market. Now, of the 14 recessions that had a negative stock market return, those lasted on average 18 months with an average return of negative 14.2%. So the question is, how though? Aren't recessions supposed to mean that things go down, so I should stay out of the market? No, it doesn't, and that's the crazy part. You can be the smartest, most brilliant macroeconomist in the world who can predict recessions, but but you'd still have no idea whether you're gonna lose or make money in those recessions because the odds of you knowing are about as good as a coin flip. So sure, you could flip the coin and maybe you'll have more money at the end of the recession if you knew when the recession was ending, which of course you're not gonna know. Or you could find out that by staying out of the market, you just had inflation eat away at your purchasing power. That's why there's plan B. So if we know that the markets are gonna fall, then why bother staying invested? Why not just pull the money out and just wait until this blows over and then put your money back into the markets?
That's a tough decision because we never know exactly when that's going to happen, right? We don't know if for sure the market's going to keep going down. A lot of bad news is already priced in. We know what the Fed's likely up to. We know that economic activity has slowed down considerably from where we were kind of at, and so I think a lot of bad news is already baked in. And so then you kind of get into the situation. It's like, well, if I sell, when do I get back in? And that's the tough decision: is when do you get back in? We heard a lot of experts, let's call them that, on the stock market say that, hey, the first half of this year, you better be ready for a volatile ride. It's a lot of predictions going around. And if you look at a day like today, Amazon sold off 7% going into their earnings. They released what I consider bad earnings. They missed on revenue, they horribly missed on guidance, and the stock is up 15% plus after hours.
How?
This is what I talk about in the market right now. Nothing makes sense short term. And if that was Facebook yesterday, the stock would be down 26%. And so right now we're in a market that literally it's frying my brain because it's like nothing even makes remotely sense in the short term right now.
I love it how people make fun of crypto being manipulated with the stock market. That's cool. We just recently surpassed $30 trillion in national debt, and the Fed is set to increase rates in March. So do you think that there's a possibility that we could either default on our national debt, or what do you think this is gonna do to the national debt?
I think they're always gonna kick the can down the road.
Sure.
And I think they're gonna have trouble raising the interest rate in any meaningful way. Meaningful way meaning like a 3%, 5% type move.
Sure, because if inflation is expected to be 7% this month, how is it possible that 0.25% or even a 0.5% increase is gonna do anything to fight inflation? It just doesn't make sense.
Yeah, doesn't make sense, I agree.
Okay, so I guess the most important question is, which stocks are a good buy? Is it specific companies for you, or is it a particular sector that people should look at? Maybe dividend stocks, maybe energy?
I think outside of a massive global recession, I think there's a tremendous amount of stocks out there that are good buys right now. There's, I would call it shooting fish in the barrel right now. If you look at small caps and mid caps, they're trading unsustainably low on a forward P basis.
Okay, so smaller companies are grossly undervalued.
Yes, smaller companies, basically almost anything under 10 billion for the most part. Many of those companies are very undervalued right now. And we're looking at a market that is very underpricing those, and the market can only trade at unsustainably low or high levels for so long. You know that's unsustainable, and then things flip and it kind of reaches a mid-range, which is where you usually should be.
Is it crazy to just be an index fund buyer like I'm doing every day? I'm just dollar cost averaging. I'm not trying to time it. I'm not trying to pick a specific stock because there's just so many things going on. It's hard to make sense of everything at any given point. So is it a bad idea or is it a good idea to just keep buying VOO, VTI, something like that?
Yeah, I think index funds are always good, especially if you don't want to put in the work, worry about the conference calls and all those sorts of things. It's a tremendous time, I think, to be a stock picker, but at the same time, if you don't have that sort of time on your hands or don't want to put in that work, the index funds, 2 thumbs up from me.
The bottom line is this: whether a recession is coming or not, and whether you know it or not, the odds of you losing money or making money is about the same as flipping a coin. Now, I don't know about you, but I'm not gonna trust my financial decision on a coin flip. But also, this logic doesn't apply to everyone, because if you're someone who already has millions of dollars and you don't have to work, then maybe you can afford to sit out of the market for a couple of years, because who cares if you miss a 20% run-up? You still have millions of dollars, your life doesn't change. But if you're somebody who's still working and saving for retirement, then trying to use macroeconomics to try to time the market just doesn't make sense. That's why I try to keep everything as simple as I can, and I'm just buying broad market index fund based ETFs. And even though personally I am fortunate and very lucky to have enough money saved for retirement, I'm still not selling everything and waiting it out, because I don't trust my emotions and my fears to act in my own best interest. Because it's one thing to talk about this stuff, and it's a whole separate thing to sell everything and then watch the market go up and down 20% every single day. I'm still dollar cost averaging because I think it's the right thing to do. And even if I lose money at the end of this recession, then I know eventually it'll come back up because stonks. And as always, have a wonderful rest of your day. Smash that like button, subscribe if you haven't already. Go check out Jeremy from Financial Education. Thank you, Jeremy, for stopping by. Love you. Thank you so much for watching. I'll see you back here on Monday and Friday, sometimes Wednesday. Bye-bye.